Imagine a laptop on a beach, a cold drink in hand, and a screen showing green candles. This is the ultimate promise of day trading. Social media is flooded with ads showing 20-somethings in private jets, claiming they found the secret to financial freedom. They make it look effortless. Why work a 9-to-5 when you could potentially earn a month's salary in a single afternoon? It is a powerful psychological hook. The idea of beating the system and escaping the rat race is intoxicating. But behind the flashy lifestyle and the filtered photos lies a much harsher reality. Is it actually possible to consistently outperform the market, or is it just a high-stakes gamble? Today, we are conducting a full audit. We are stripping away the marketing hype to test these bold claims against the ultimate financial benchmark, the S&P 500. Time to see if the dream actually holds up. To beat the day traders, we first need to understand the yardstick. Meet the S&P 500. It isn't just a random number on the news. It represents the 500 largest, most successful publicly traded companies in the United States. Think Apple, Microsoft, and Amazon. When you buy an index fund, you're betting on the collective engine of American capitalism. Historically, this index has returned about 10% annually over the long haul. That sounds modest, until you factor in the magic of compounding. This is the essence of passive indexing, doing absolutely nothing and letting the world's best CEOs work for you. For retail traders and professional hedge fund managers alike, this index is the final boss. Most people spend 40 hours a week trying to outsmart it, only to realize that the market usually wins. If you can't beat the benchmark, why are you even playing the game? Step into the world of FinTalk and YouTube, where every day looks like a jackpot. You've seen the videos. Flashy gurus flashing huge profit screenshots while sitting in front of rented Lamborghinis. They make it look effortless, but there's a massive catch. This is the social media mirage. These influencers curate their lives, showing you the one winning trade while hiding the many losers that blew up their accounts. It's a classic case of survivor bias. We only see the 1% who got incredibly lucky, while the vast majority who went completely bust remain invisible. For most of these gurus, the real money isn't made in the markets at all. Their true business model is selling you expensive courses and private signal groups. They aren't professional traders, they're professional marketers. They profit from your hope, not their own trades. Now, let's take a deep look at the actual statistics. Now, let's look at the cold, hard numbers. Academic researchers like Barber and Odean have spent decades tracking the performance of retail traders. Their findings are a sobering bucket of ice water for anyone chasing the day trading dream. The data consistently shows a staggering 95% failure rate. This isn't just a temporary dip, it's a total wipeout for the vast majority of participants. While a lucky few might outperform the S&P 500 over a single month or even a year, those numbers crumble when you extend the timeline. By the 5-year mark, the percentage of individual traders beating a simple index fund drops to nearly zero. It's not just about losing money. It's about the sheer lack of sustainability. Most traders aren't just fighting the market. They are fighting the laws of probability. Statistics prove that for most, active trading is a mathematical dead end. Period. Even if your broker offers zero commission trades, you are still paying a heavy price. It starts with the bid-ask spread. That tiny difference between the buying and selling price might look negligible, but when you're trading dozens of times a week, it adds up. Then there is slippage. By the time your order hits the exchange, the price has moved, and you're filled at a worse rate than you expected. This is the hidden friction of active trading. Beyond the trades themselves, you have the death by 1,000 cuts. High-speed data feeds, charting software, and platform subscriptions can easily drain hundreds of dollars every month. Compare this to a simple S&P 500 index fund. Modern ETFs have expense ratios near zero. You buy once and pay almost nothing to hold. While the day trader fights a constant uphill battle against fees, the passive investor keeps every single penny working. Even if you beat the market after fees, you are not home free. The tax man is waiting. Day trading profits are categorized as short-term capital gains. This means they are taxed at the same rate as your regular income, which can climb as high as 37%. Compare that to the passive investor holding the S&P 500. By staying invested for over a year, they qualify for long-term capital gains rates, often just 15%. That is a massive, immediate advantage for the index fund. Then there is the dreaded wash sale rule. If you sell at a loss and jump back into the same stock too quickly, you cannot even claim that loss to offset your wins. It makes your accounting a nightmare, and your net returns even smaller. Passive investing allows your wealth to compound silently and efficiently, keeping your capital working for you. Let's say you actually finished the year with a 5% profit over the S&P 500. On a $50,000 account, that is an extra $2,500. Now do the math. How many hours did you spend staring at flickering candles? If you spent 40 hours a week researching and executing trades, you have worked 2,000 hours for that bonus. That equates to a staggering $1.25 per hour. Is that really financial freedom? Most day traders treat this like a hobby, but pay for it like a full-time job. This is the hidden opportunity cost. Every hour spent decoding technical indicators is an hour stolen from your primary career, your business, or your family. Meanwhile, the passive investors spent 0 hours managing their index fund. They enjoyed life, while wealth compounded in the background. Trading is not just a risk. When you click buy on your laptop, you aren't just competing against other retail traders. You are entering a digital arena dominated by high-frequency trading algorithms. These machines execute thousands of orders in the blink of an eye, often reacting to shifts before your screen even refreshes. This is the harsh reality of institutional dominance. While you rely on a standard home internet connection, Wall Street firms spend billions on infrastructure and servers, housed directly inside the stock exchanges. They aren't just faster, they are better informed. This information asymmetry means you are almost always the last to know when market-shifting news breaks. By the time a headline reaches your social media feed, the big players have already moved the price. You are essentially bringing a pocket knife to a high-tech nuclear standoff. In this lopsided arena, your perceived edge is usually just an expensive illusion maintained by the house. Trading isn't just about charts and numbers. It is a mental battlefield. When you watch your hard-earned savings vanish in real time, it triggers a primal stress response. This often leads to the revenge trading trap. You feel a desperate need to win it back immediately. You take bigger risks, ignore your rules, and double down on losing positions. This emotional spiral is where most accounts go to die. Even if you stay disciplined, decision fatigue sets in. Making hundreds of high-stakes choices every day drains your mental battery. Your judgment slips. You make a catastrophic error simply because you are exhausted. Contrast this chaos with the set-and-forget nature of the S&P 500. There are no red candles to haunt your dreams, no heart palpitations at the opening bell. Passive investing offers a level of total peace of mind that no active day trader can ever hope to possess. Let's look at a hypothetical year. You start with $10,000. You're disciplined, or so you think. You've studied the charts. You aim for a 50% win rate, which is actually quite high for a beginner. On your good days, you're up $200. You feel like a genius. But then, the big losers arrive. One bad earnings call or a missed stop loss wipes out 2 weeks of gains in 20 minutes. Now let's do the math. After hundreds of trades, you've paid thousands in commissions and platform fees. Then comes the tax man, taking a massive bite out of every short-term win. Factor in inevitable emotional errors, the revenge trades and the panic sells, and that $10,000 starting balance begins to bleed. By December, most active traders find themselves underwater, exhausted, and significantly poorer than when they first started their very difficult trading journey. Now let's look at the alternative. We take that same $10,000 and put it into a passive S&P 500 index fund. There are no daily charts to watch, no stressful news alerts. You just set it and forget it. Throughout the year, the companies within the index pay out dividends. With a dividend reinvestment plan, or DRIP, that cash is automatically used to buy more shares, fueling your growth without you lifting a finger. While the active trader was fighting for every penny and losing sleep, your money was working quietly in the background. Because you did not sell, you triggered zero short-term capital gains taxes. Your liability remains deferred, allowing your wealth to compound effectively. By the end of the year, your balance reflects the steady climb of the American economy. You achieved a solid return with zero effort, zero stress, and a minimal tax. Raw returns tell a lie. You might see a trader brag about a 20% gain, while the S&P 500 only returned 10. But here is the catch. How much sleep did they lose to get it? This is where the Sharpe ratio comes in. It measures risk-adjusted returns. A 20% gain achieved through extreme volatility is mathematically worse than a steady 10%. Why? Because high volatility introduces the risk of ruin. In day trading, you are often one bad afternoon away from a total wipeout. You can win for 300 days straight and lose everything on day 301. The S&P 500 provides an inherent safety net through diversification. You aren't betting on one chart pattern. You are betting on the 500 largest companies in America. While the trader gambles with ruin, the index investor enjoys a smoother ride towards sustainable long-term wealth. Day trading is a race against the clock, but the real secret to wealth is letting time do the heavy lifting. We often hear that timing is everything. In reality, time in the market beats timing the market every single time. When you jump in and out of positions trying to catch the perfect wave, you risk missing the most explosive growth. Statistics show that if you missed just the 10 best trading days over the last 2 decades, your total returns would be cut nearly in half. Think about that. By sitting in cash, waiting for a dip that might never come, you're sabotaging your future self. Long-term holding isn't boring. It's a mathematical miracle. It turns modest, consistent savings into a massive fortune through the power of compounding. You aren't just saving money, you're building an army of dollars that work for you while you sleep. Start now. If you still feel the itch to trade, there's a smarter way to scratch it without risking your entire future. It's called the core and satellite approach. You put the vast majority of your capital into a low-cost S&P 500 index fund. This is your foundation. Then, you take a small, manageable portion for your active plays or individual stocks. This limits your downside while letting you participate in the market's excitement. But here is the real secret to wealth. Focus on your primary career or business. Instead of obsessing over an extra 2% return through stressful day trading, use that energy to increase your actual income. If you earn more, you can invest more. A larger principal compounding at 10% beats a tiny account with lucky trades every single time. It's about building a portfolio that finally works for you while you sleep. This is true freedom. After auditing the numbers, the verdict is undeniable. Day trading isn't a shortcut to wealth. For most, it's a fast track to frustration. While the allure of quick profits is strong, the statistical reality is brutal. Between taxes, fees, and the sheer mental toll, the active trader starts every day at a disadvantage. Meanwhile, the S&P 500 quietly compounds. It doesn't ask for your sleep, your sanity, or 40 hours of your week. It simply works. We've debunked the myth that you need to beat the market to build a fortune. In fact, trying to beat it often leads to losing it all. True financial freedom isn't found in a frantic chart. It's built through patience and consistency. Stop chasing the noise of the next big trade. Focus on your career, your life, and long-term growth. The audit is clear. Buy the index, trust the process, and win the game.